G'day everyone, welcome back to another episode of Spark Your Fire. I'm your host David Shih, and as always, I brought in another property investor today. Very established actually, and very, I would say Steve is definitely one of the very big portfolio owners that you would be able to see. Most people probably on a single digit. Steve, I think you're on a bit of a double digit at the moment, if not moving towards what,
Uh,
100.
Early double digits. I think you're roughly at the moment a bit about 11 mil. So it's spread across. I think it's 13 or 14 properties. So yeah. No, we're quite happy with that. Um,
Amazing. Amazing. And look, it's Steve Ash from Property Strats, by the way. Apologies about the introduction. I got too excited having big
Me too.
property investors coming in. But anyway, today we want to talk a bit about your property journey, Steve. I think, everyone loves a good property story, especially what they want to know is, as an established property investor who's got 11 mil under your belt today, what sort of things, what would you do differently? How did you get there initially, especially lending is being a challenge throughout the whole
Yeah.
time, right? So you obviously didn't build your portfolio within the last few years. It probably takes decades and that kind of stuff. So it takes time. Lessons learned across the board and any strategy that you may have deployed, which may have worked or may not have worked as well. So, we'll keep it very like the usual style is very free flowing. So, Steve, we'll have a conversation basically as if we're chatting face to face, property investor, sharing our knowledges. That's the idea about what we're digging in today. Okay, so um, let's start off
Always
with.
always love talking about property. So yeah, all good.
Oh, I reckon we can go on forever. That's the main thing. I need to watch
Probably.
job all the time. So, but
Yeah.
good to have you
Yeah.
on, Steve. And all right, so let's kick off. Tell us a bit about yourself. Like, what were you doing previously when you were building your property portfolio? Were you working in big corporates, and how did it all started?
Yeah, no, it's interesting. So yeah, I've been working at some of the big corporates. So I'm a POM, I suppose you could say. So England and so I've always, I backpacked around Australia when I was like 2000, 2001, like a lot of English people do when they go around the world, and always wanted to come back. So there was an opportunity to come back, I think late 2006, and to watch the cricket. And so I came over here, and at that sort of time, I was working in London for one of the English, well, so Hong Kong bank, HSBC, and I was working on the trade floor there. And so after the cricket finished, I was lucky enough to get sponsored by a company called State Street, which is an American custodial bank,
Oh, yes.
and I started working there, and I don't know why I had this in my mind, but I was on a 457 visa, and I just decided, like, I was renting this property in Surrey Hills. It was quite a small property, and it had that busy, I think it was Elizabeth Street just outside. And I was like, oh, I'm just going to buy a property, I think, and because I don't want to pay this crazy rent. And I spent ages looking all around. I went around across the suburbs like Five Dock and Leichhardt and all these places, and someone tipped me off about a suburb called Kogarah, which had a fast train line, and
Yes.
we found this deal. It was about 460, like oversized apartment, about 170 square meters, but someone had bought it, and then we got an off market because we basically had the next door. He said the owner was thinking of selling. Did you want it? And we got it for 442, and there
Wow.
we go. And I had to apply for Foreign Investment Review Board approval and all this, and I had no idea what I was doing. But I was a property owner pretty quickly since coming into Australia, so that's where it all started.
Was that the first property, basically in Cogra? Yeah.
It was, yeah. It was a two-bed, two-bathroom with a mezzanine level. Yeah, in Cogger, right next to the station. And yeah. So 442. It's yeah. And we're away at the races. I mean, that area, it was kind of a little bit rougher at that particular time, but we loved it. We go to Dolls Point, we could go down to the national park and over to Cronulla every now and again, easy to get into the city. So yeah, I thought it was awesome. And the Five Dock properties are only about 80 square meters, so like shoeboxes. So with high strata costs. So yeah,
Was this
yeah.
back in 2010 or even earlier?
No, this is actually, I'd literally only been in the country 6 months. So
Oh,
it was 2007.
doesn't.
And I had no idea about mortgages. So I went straight into St. George Bank because
Oh,
that's
yeah.
where they were based in Kogarah.
Yeah.
And I was like, yeah, what can you do for me? And they were like, yeah, that's okay. You just need to get this Foreign Investment Review Board approval. And then off I went. So
Beautiful.
there we go. Yeah.
And you live in it, right? Initially, because you purchased it as an owner occ or yeah, yeah.
Yeah, owner op, we lived in there, and yeah, fond memories, actually very fond memories of that sort of time. So my now wife, we started dating around that sort of time,
Yeah.
and uh, and yeah, and the career was going, doing quite well at State Street. So we had this like entertainment book. Someone tipped us off, so we're going at eating and using those discounts at all the restaurants. So it was good fun. But yeah, I mean, we took a fixed rate mortgage. We had no idea what we were doing, and yeah, no, it was fun.
Back
Yeah,
in 2000, that was about 2000. Well, I mean,
2007.
2007, that interest rate would have been fairly high at that point in time. You fix your mortgage too, right? So,
Yeah, we fixed it 7.6 from memory,
ooh,
and I always remember that like it's I've talked about it maybe on before, but like it was a bit of a seminal moment. So after I bought the property, there was a couple of things. I had a group of English friends, and you can guess where they were living, like Bondi, and and they were basically saying, "Oh, why did you go there? You should buy in Balmain." But that was one story. But the second story was even like it's one of the people at State Street. We used to have Friday drinks. This was before the GFC, where it's a little bit more, kind of loose, but I won't go into that. And we're talking in the bar, and she was renting a property in Manly, and she basically, I said I just bought this property in Cogra, and she was like, "What are you doing? There's going to be a house crash."
yeah.
And I was like, "What? Seriously? Like you think so?" And she goes, "Yeah, yeah, no, no, I'm renting, but I'm just waiting for the prices to crash, and I'm going to buy this Manly property for peanuts and
Mm.
yeah." And I was like, "Oh, I don't think that's going to happen, but yeah, no, I'll be careful." And can you believe? And I still hear that conversation in 2024. Like, there's always going to be a property crash somewhere. So yeah,
There's
quite
always
funny.
everyone is entitled to their own opinions at the end of the day, right? They believe what they believe, they see the world how they see the world. So,
Yeah,
20 years long, there will be people that believe they're still waiting for that crash, and I'll say 20 years later, there will still be some people that's on the fence still waiting on that crash to happen. Who knows?
is that one day there'll be like Harry Dent and all of this guy. No, there was that guy at one of the universities. I forgot his name. He was on the forums, like he's always predicting doom and gloom.
Yes,
Um,
that's what they
but yeah,
sell. That's what they
it
sell.
is.
Okay.
It is.
All
Yeah.
right, so started off in Kogarah, in a very little two-bedder unit, convenient. And where did it lead you? So what happens from there?
Yeah, so we got the property, and like you just alluded to, the rates were quite high then, and actually we were actually in a bit of stress, and I think everyone probably goes through this sort of journey with property, speaking, on affordability. But I think our stress was about the mortgage was about 55% of our earnings at that time, so
Mm.
it wasn't easy, and we were really quite we a bit of austerity really in the Ash household then, like 2 years of just being very careful. I remember having these cheese and pickle sandwiches for lunch every day, and uh, and just really eat. But that's kind of when I thought about a year in, like I started like seeing if I could do something, because rates I think came down
Hmm.
um, just about a year after, and it was and all of a sudden we're paying a lot of money and we're fixed in,
Hmm.
and to break the loan was about 30 grand or something, and so that's when I started the education piece, and I started looking at the property forum called Summersoft, and I found a like a pretty seminal book by, well, obviously the owner of Summersoft, Jan Summers, and building wealth via residential property, and still people I speak to now, and you just got to change the numbers in that book, but I think they're just absolute gold in that book,
Yeah.
and I got educated, and then I was raring to go, but I couldn't do anything because of the fixed term. But I was educating myself there, and I just that was just such an invaluable resource to me back
Mhm.
then.
So that was the education period, basically. And how
Yeah.
long did you immerse on your in that forum before you kind of started looking and getting into the next property game again?
Yeah, well, I spent because I was looking at stock a little bit then as well, but because of my position, and I could see order flow, and the compliance around all of that sort of stuff, it was just too hard basket, and plus I probably wasn't very good at it, and so property just kind of made natural sense, and I think I looked at kind of who'd been who was in the rich list and who'd been pretty successful from a wealth point of view, and there's a lot more people from property than there is from stock, for sure, and it's because you can leverage your money safely, as you know, and so it was really quite a lot of education, and then sort of about 2.5 years
Wow.
after that, I connected with a couple of brokers, and yeah, and I started learning we were getting prepared, but I just couldn't pull that trigger. I remember looking at Blacktown at 300,000 and Lake Ember apartments at like 170, 180,000. But I had a bit of analysis paralysis and I just couldn't pull the trigger. But then came the big moment for us really, which maybe changed. It did change our life actually. And like we were getting, my girlfriend and I then decided we were going to get married, and we decided that okay, we needed a house, and we kind of like found this property in Baulkham Hills, which seemed it's quite expensive at that particular time, but it was we thought it was pretty good value. 22 to 24 Ks out, so 685,000. And so we were going to sell the Cogra property. This is a seminal moment, really, and then buy the Baulkham Hills. But the broker at the time said, "Well, no, don't do that. Just rent out the Cogra property. You've got enough equity now, sort of from." I think that the Cogra property was a reevaluated 600,000. So we could extract equity out of that. And I still had some savings, etc. And so we used that to do an 80% lend on the Baulkham Hills property. So we were in property investors then, really, and with 2 properties under our belt, and I suppose a portfolio value then at 1.2 million, and this would have been 2010 or something.
It's amazing, right? So, at that point
Yeah.
in time, like 1.2 mil is very different to 1.2 mil today, that's for sure. Fast forward like 15 years.
Yeah, 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 and it was scary, but I think the property rented I think for 550 a week then,
Yep.
so and strata costs were pretty small on that because I kind of stuck to no lifts, etc. And so yeah, it was kind of taking care of itself, and so at the game, and we kind of saw the benefit was just seeing when you see your property. Um, like the Cogra one, 440 to 600, go up 160 in 3 years. We're just like, well, okay, there's something to this, and then I started reading some stuff a little bit more,
Yes.
and seeing some of the good investor stories there, and then that's when I think we were in Baulkham Hills for about 6 months. We had a bit of growth, and we did a 90% lend, and we then did it. We did then go out and buy another property, and this was. You would know this very well, like West Sydney. I was talking about Blacktown a second ago. We couldn't pull the trigger on Blacktown, but we did this time, and it was North St Mary's. And
No.
so we were able to get in there at 240,000, and
Oh,
still own that one. So
it's serious.
yeah,
Like 240,000 for a house at St. Mary's on what, 600 square meter block?
yeah, 560, I think, is a corner block, but you could put granny on there, or I think you put duplex on there now. But at that particular time, 240 renting for 330 a week it was, and yeah, it was. I wish I could have bought more, and actually I wanted to buy more, and it was really. I've talked about the story a little bit, but this was when I was working at Goldman Sachs, and I don't know. I was kind of looking at properties all the time at this particular moment, and one day a couple of option traders saw me, looking at I think a property in Lethbridge Park it was, and it had this graffiti on somewhere. Do you remember those sort of properties? And they're like, "What are you doing? You're going to lose all your money. You're a slum on and rah rah rah." And I kind of listened because I thought, well, these guys are, they're pretty smart, and I didn't go ahead, and that
Oh,
was, I mean, at least it wasn't a tragic mistake, but it kind of like, yeah, we did miss out. That was absolute gold that period.
Leverage
Yeah,
Park is that's out in the south west that's western corridor as well, right?
yeah, West Sydney. So it's just it's not too far from St Mary's, so it's
Yeah.
in that sort of like
Okay.
zone between Mount Druitt and St Mary's. There's Tregear and Plumpton, a few others. So
Yeah.
that
Yeah.
they Wayland, they're all kind of about 180 to 200,000 then, and on 500 to 700 square meters, and
Oh, I know. That's when
yeah,
that was the golden prime time when Sydney was still affordable. And look at the
yeah,
prices today. It's very different, right? So wish everyone could go
it
back to
is,
that period. But out of
yeah.
curiosity, like why did you choose St. Mary's for your like for that purchase around that time? Like was it specific? Was it because of a cash flow play? Was it because of a what attracted you to the area?
Well, it was the education. So I was reading the forums, but I mean, I'll talk like there was a guy called Nathan Birch
Hmm.
back in those days,
Yes.
and he used to do. I mean, he's obviously still around
Still
today,
around.
um, but he was posting these videos back then, and he was going in and he was going in and doing a cosmetic reno for 10K. And really that sort of inspired us, sort of, and it was the equity uplift, rip it out, go again, manufacture sort of equity growth, and then keep going. And so kind of like that kind of made a lot of sense, especially at those sort of returns.
Mm.
And yeah, we jumped on board, and it didn't take long actually for that area just to then take off. I don't know if it was Birchie who kind of propelled that, but yeah, it did do very well. Mm.
Was it meant to be a buy, renovate, equity release type of strategy initially for that St Mary's property?
Yes,
Yeah.
yeah. The idea was to keep doing it,
Okay. Yeah.
yeah, and sort of and just keep just keep getting the same sort of deals because we had 90% lend on that particular time.
Yeah.
We were kind of like the LVR was quite high, and when we came, I think I know I remember quite clearly that Goldman it started getting a bit busier, and there was a few things around that sort of time. Obviously, I told the story with the option guys, and I just thought, am I doing the right thing here? And that's kind of where we actually deviated path, and
Mm.
it was really that conversation really, and also sort of my talking to my broker because he had a very different strategy. He just thought buying in West Sydney was crazy. What are you doing? Like just but look for properties value add, subdivision potential. And so I listened to him a little bit, and that kind of
Okay.
was the catalyst for a bit of change.
Yeah, right. Okay. Okay. So, all right. So you tried the buy renovate in St Mary's, but then again, the strategy changed again for the next property because you weren't sure because you had so many different opinions that's around you, which
Yes.
started it making yourself questioning yourself and say, is this actually the right strategy? Should I still buy something else that I can renovate and then pull equity out and go again, or should I look at potentially develop implement a different strategy moving forward?
Yeah. Yeah. And
Mm.
I think we'll come back to this theme in a second. But I think property investing is quite easy, but it's quite boring, but it's quite as humans we sort of like to overcomplicate things, and I think I was in a time in my life where I did overcomplicate. So my broker, I mean, he was an incredibly successful investor himself. He had about 400,000 passive income a
Wow.
year, and if you think about that in 2011,
Yeah.
that's massive. And so we just kind of thought, well, we'd like to replicate what he'd done, and so kind of again looking and doing my own research, I thought Melbourne at that particular time was prime for investing. And so that West Sydney had grown a little bit then. It actually grown a little bit, grew a lot,
What,
and so all of
400,
a
200
sudden
to $400,000?
it was crazy. It's about 400 or 500 in no time from memory. Um, and so it didn't really make sense anymore. Like, 500 renting for 350 a week.
Yeah.
And there was a lot of people buying in Newcastle and other areas, I think, back then. But I kind of wanted to sort of change tack. And I thought Melbourne, was a pretty good play. So we kind of looked, we had a buyer's agent on that particular one looking for kind of, you know, split up blocks like my broker was doing. And we
Okay.
found this site. So we're looking at this time Preston, Footscray,
Oh, yes.
but we found an area and found a decent one in Pascoe South, which only 7-8 Ks from the CBD. It's about I think 550 square meters where you could retain the front dwelling, subdivide and build two at the back. And so we're quite excited about that one.
Mm-hmm.
But this is kind of where we did make our first sort of mistake. So we kind of really,
Okay.
kind of trusted what the buyer's agent was telling us. We flew down to have a look at the property. We couldn't get in that day. And then we found out why a couple of weeks later. It's actually a wreck, whereas the buyer's agents were telling us we could renting out for sort of 300, 350 a week. It was I think it's about 450 purchase, something like that. And so all of a sudden we had these holding costs, and it was about 100,000 to renovate the main property, and it was like, okay, this is a bit tricky. So
Yeah.
so we did the subdivision, did all of that, did the plans, but and then the second kicker came. So we had the first one with the property, but when we came to do the feasibility well, not the feasibility, but the quantity surveying work, like there was a pipe going right through the property. It's much easier to detect that now with tools, but it really made the feasibility kind of unprofitable. So the main reason why we'd engage these buyers agents to find a development site was actually, completely down the tubes then. So
Oh, well, that's
I was
fine.
busier than ever as well at that time at work. So it was a bit of a stressful time.
So just because of that pipe that's undergoing that block of land, that's basically stopping the subdivision
No,
plan.
you could
Is that
you
right?
could do the subdivision, but what it did is because the amount of money it took, I think it added another 100,000. So you had 100,000 for the main house and another
Yeah.
100,000 to relocate
Oh,
pipes, etc., and get extra approvals, and it just
ouch.
made everything
Numbers don't.
unprofitable. So then you had
Yeah.
to look at maybe knocking the main house down and then building three, and it was like that was way too much money for us, and so we had the plans, and we just thought, okay, like let's just sell this off and go again. And we came away with a minor loss on that one. But live to fight another day. And I mean that property would be worth quite a bit now, but it was a right call to
Mm,
get rid of it. So yeah, in
Okay.
hindsight, we were just better off just buying anywhere in Melbourne that you could rent out, and we'd have done incredibly well.
So you couldn't get access to the house initially when you're purchasing the property. So you don't know what the inside is looking like. Is that
No, no,
what?
yeah, exactly. We had the pictures, but I mean, back then, I suppose you didn't really have the smartphones, or the Apple phone and
Uh,
iPhone had only been around a bit. But
uh,
I kind of like you trust the buyer's agent that they're gonna do all of this for you and do the due diligence. So when you get all the information and you can see it's going to rent for 300 to 350 a week, you think, well, that's good. So that you live and learn. You haven't made that mistake again. So
so that was
yeah,
the
yeah,
first mistake where the house actually needs a lot of renovation to be able to get up to that level to be able to rent it out at 350 or more.
yeah,
And
yeah,
then the second one was that oversight in terms of that piping underneath the subdivision lot, which is going to be another costly exercise of about 100K or plus to be able to get that
yeah.
pipe relocated in order for subdivision to proceed.
Yeah, yeah,
Or,
yeah, exactly. And at this time, like I was working till 8, 9 at night or whatever it was, and
uh,
it's just kind of the last thing you sort of want. And I think, yeah, it was a fairly sort of stressful time. We had the holding costs obviously for the property for about a year,
yeah.
and yeah, so yeah, we did burn for a bit of equity on that one, and but we sold it for about I think 525, 30 or something.
With the BA in place,
Yeah,
basically.
with the DA, yeah, and someone else I think ended up doing the project. So,
Yeah, right.
yeah, we came out, wasn't very happy with this experience, but you take these lessons and you then try and learn from them. So, but yeah, yes, but at that time when we sold that, we still had the three properties, so we weren't in an awful position. So.
It just, I guess you live and learn, right? So and you had a taste of what subdivision process is like as well, which I'm sure was going to help you later down the track when you have future subdivision deals too.
Yeah, yeah, no, it will, and I mean, I maybe shouldn't, and I think at some point, like we can talk about again, like there's obviously lots of deals that we're looking at now with subdivision potential, but I think like coming back in 10 years or 20 years, I think is a good way to look at it. Then it's like shooting fish in a barrel. The feasibilities stack up, but then if you've got borrowing capacity, and I say this to quite a few people now, like yeah, I mean subdivision sounds sexy, yeah, or people building granny flats, but why do it? Like use that borrowing capacity to get another property, basically. Mm.
Exactly. Exactly. I think
Yeah,
the main thing. So, do the project later, but you can acquire the sites for now as long as numbers stack up, right? Like it makes sense to acquire the potential block. And I think that's part of the journey that everyone kind of had to go through, which I'm sure at that point in time when you're looking at it, because you already have certain enough knowledge about property investment, you wouldn't be happy with getting a buy and hold property. You'll want something more now because you've
yeah,
now got a couple of properties. You go, I don't just want a bread and butter property anymore. I want something that I can actually do something actively later on as you acquire as you continue to say, let's say, for example, you max out your borrowing capacity, right? Something that you can
yeah,
actually actively deploy, whether that's granny flat, whether that's subdivision. So I think it's a natural course of progression, essentially, that you want to try out different things, but it's also at the same time very dangerous in terms of changing your strategies because you had your mind on the buy, renovate, pull equity, which is fantastic because before 2015, it's so easy to do, right? Like there's no
Yeah,
lending
it
limits. You can
was.
literally just go buy, pull,
Mm.
buy, pull, buy, pull, and then keep going like that. But
Yeah.
anyway, it's just I guess that's part of what it is.
Yeah, it's just part of what it is, and live and learn. And I think that's been a bit of a story. Like we've obviously done well to get where we've got to,
Absolutely.
but I have changed up the strategy a couple of times, and I think that not I don't do that anymore. But back then, I think I was just so interested in trying to give it a go and just seeing if I could replicate. I suppose it was my mentor to some degree,
Yeah.
but one thing I have kind of worked out now is that sometimes like you resonate with certain kind of strategies. And I don't think that there's just I think it's one strategy I've never managed to sort of like master really. But I do think the opportunity of building a foundational portfolio, like you just said, and you come back to it. That's that. If we did it again, it would be doing it that way for sure. Like the
Mhm.
St Mary's one, like that really stacks up obviously now. So yeah,
Yeah. No, absolutely.
yeah.
I think that's good. Okay.
Yeah.
So what happened after the Pascoe property? Once you sold it, what happens next?
Yeah, so we were kind of thinking about what to do at that sort of time. Like Melbourne did boom actually, so we were right. We just got the wrong asset, and so Melbourne went up quite a lot. And then we're thinking about what to do next. And this is kind of when there was a lot of talk about going up to Brisbane and investing in Moreton Bay and Logan. And we sort of like thought, okay, we looked at it, and in Logan at that time, was it houses were about 230, renting for 320, so it's like West Sydney all over again. And so we went up there trying to find something. We actually settled in a place called Loganley, and we bought two properties there side by side, quite close to the station. We paid a little bit more for them. So a little bit more than kind of like, and we actually had to chip in a bit of equity to get the deal done. But they're about 400 square meters, I think, to Loganley Station and 1,600 square meters of land, which was zoned for sort of townhouses and
Yes.
apartments. So it's a bit of a land bank in play, that one.
Okay.
And so we're back in the race there, but very early to the Brisbane market. So yeah, back in 2015, I think this was, or 14,
That was
somewhere then.
Yeah,
Yeah.
I remember there was I was looking around Logan around that time as well. And I know Logan Lee, I think there was that pocket around the train station, which is his own townhouses. So I think I know roughly what you're talking about, the little block around those areas. How big was the block of land then? 1,000 square meters or
Each one was 800 square
each
meters,
one's
so
800? Beautiful.
combined 1,600. So
Wow.
yeah,
Yeah, well,
yeah,
okay.
yeah. And if you fast forward, like our last purchase was the third one in a row, so we've got 2,400
Oh,
square meters there now. So you can put apartments on there, and
good land
it's
bank.
not the time to do it, but it's again the land banking. We'll just hold it and just wait, like we're talking about shooting fish in a barrel. Like that's kind of like the play on that one.
And how much did you pay for each for the two at that point? 200 or
So
$1,000
so this was 410
or
each.
10 each?
So it's quite expensive for
Okay.
Loganley then, and yeah, it was. Yeah, we kind of thought maybe well, I think we did overpay because obviously we had to chip in more money to make the deal work. But we thought there was enough in there. At that time, as you would know, like the vacancy rates were quite high in
Mm,
Logan, and
mm,
so that I mean there was a few dramas on those properties for sure, like lower socioeconomic,
mm.
sometimes some extended vacancy periods, but yeah, no, we still obviously still hold those with the one we've just purchased, and but yeah, and I think so we're back in the game there. We'd actually moved down to Melbourne uh, around that sort of just after we bought the Loganley properties, and sort of like if we go back a little bit, so this is a strategy. There's a lot of talk about rent vesting these days, but we didn't. Obviously, we were on the market, but what we did is we had the Cogra property. We actually sold that in 2013
Okay.
for about 800,000. So
Mm.
units don't
There you go.
grow. That's kind of like the counter to that argument. And then and that was really because Cogger was being rezoned and they were going to build high rises. So we just decided, okay, capital gains, no capital gains, let's get that out.
Yes.
Then Baulkham Hills basically doubled, like it just went crazy, and
Amazing.
we sold that for 1.3, and then
Mm.
we moved down to Melbourne and went to a suburb called Mount Eliza. on the Mornington Peninsula. But instead of like going and buying a $2 million place, we bought 700,000, and in a place I thought had real good prospects. And but really, we're just eradicating the debt each time
Yes.
on the property by using capital gains to our advantage and being nomads.
The
And
6 years,
so I
basically.
think that's
Right?
I think that strategy has been massive to our success. And just really just trying to get that non-deductible debt down.
Mm.
Um,
Mm.
so we went down there, and so we had at that particular time the Mount Eliza property. We had the two in Logan, and we had the St Mary's, and yeah, and sort of so they're enjoying life in Melbourne, uh, and yeah, and I went to try and get sort of more sort of loans, etc. But that's when you were just alluding to kind of like the changes at APRA, and it was just so much harder to get loans then.
Yeah.
So it did hinder our progress for a little bit after that, even though we had so much equity, we just didn't have serviceability.
Yeah. I remember that time, it was killing a lot of property investors because, you can literally just buy Logan properties and you can still keep going because each of them pretty much positively cash flowed. Same thing with the ones that you bought in Western Sydney, right? The St Mary's
Yeah,
one.
yeah,
But yeah, that change has completely revamped the game. So, I remember property investors, we all have to, there was a lot of discussions on, I think property chat, it has evolved into property chat at that point in time.
yeah, yeah.
Everyone's kind of talking about how do we work around this, right? As a collective.
Well, yeah, exactly. Yeah, all the kind of need to learn new tricks, etc. Yeah, and I do remember the big chat there, and it was and we kind of faced with what we were going to do, and sort of like, again we started thinking, and I mean I don't know if you remember this this particular time, but like when it got to say 2018, for example, like when Logan hadn't grown for 3 or 4 years, you started to think, especially with the high vacancy rates, well, have I done the right thing? And you start second guessing yourselves. I mean, it's easy in hindsight to look back on that, and you do gain a lot of insights now as an investor, but when you're living it, it's not so easy. And we're trying to get this borrowing capacity sorted out, and when I was able to do it, we kind of went and bought again in Melbourne, like, and you're saying about repeating mistakes, but we bought in a suburb called Reservoir,
Oh, yeah.
which was in a residential growth zone area. So there'd been a bit of rezoning in Melbourne, so you could again do high density. So it's the same as a Loganley play, but in Reservoir. And I thought that, like, instead of trying to get cash flow properties, I didn't think how the cash flow, like to your point, we'd be able to keep buying and buying. So I thought this could be a really good capital growth play,
Mm.
and yeah, we did the same sort of thing, DA and everything, and yeah, but I was busy. Like, I started to get busy and work again, and we picked that up for 840, I think, thousand. So yeah, and so 2018, and again did the plans, and then I think there was a story. It's actually just before around that sort of time on property chat, and I was a little bit kind of like thinking, okay, we done well. I think the portfolio was about 3 million then, and the LVR was maybe about 40%, I think,
Good, very
and
good.
I was just, but I'm overly harsh on myself, and even though we were doing quite well, I thought I could be doing better, and like what sort of strategy. And there was a story on property chat, it might have been Summersoft, of one of uh, an investor who had done really well just buying in Logan and just buying the same sort of properties and keeping it really straightforward. And I thought, oh man, like I had minimal gains through that period, but they're not. But was able to hold all of his assets and build an asset base to a certain amount of money, and it was like,
Mm.
well, this is going back to like that strategy again, like in West Sydney. Why didn't I just keep doing that?
Mm.
And so work was getting really quite tough. Some really nasty things happening.
Mm.
People getting sacked. And I think, I thought, okay, right, I've got a bit of a pay jump. My wife's working again. Um, we've got all this equity. Let's just see what we can do if we hold the reservoir property or
Okay.
if we sell it. And so we did the plans and everything. We ended up selling that for 1,050,000.
Mhm.
Um, and well, but we also, the other big thing, like, again, we didn't. My wife, actually, sorry, my family didn't settle in Melbourne, so we decided to make the move up to Brisbane. And so we
Ah,
sold the Mount Eliza property, and we bought a property here in Tarragindi where we are at the moment, debt free,
that's
for
why you
one
moved
million and
up.
ninety thousand.
Yeah.
And again, like we thought it was good buying because there's a property like 1.5 that had just sold a couple of streets over. So debt free here. But then we really kind of like we sold the reservoir property, we extracted equity from the PPOR and all the proceeds. So we sold reservoir for 1,050,000, I think it was.
Mhm.
Um, and then just reassessed all the loans and just thought, okay, how do I get myself not reliant on work anymore? Like, what do we need to do?
Yeah.
We, and then the decision was to go back to the cash flow strategy, and that's exactly what we did. And we went hard this time, uh, and started buying in Brisbane again, like in 2020, I think it was. So
Mhm.
we bought up in Moreton Bay, we bought in Ipswich in Goodna. So first property there was. Am I going too fast, or is this all
No,
good?
that's okay. Look, I think it's. I think you pretty much had the good outline of what you were planning to do. So which
Yeah,
is fantastic. Okay, so yeah, so you've so now for this time you know exactly the direction that you want to go down with. So and it's going to be Logan, and this is back in 2010. I think from memory, the property prices hasn't gone up that much around Logan. I think it might be still. It has gone up a little bit, but it's not significant at that point. Am I correct?
yeah. You're right. So it's 2020
Yeah.
and well, maybe 2019, but maybe more
Okay.
2019
Okay.
to 2020.
Just
So we
before
started
COVID.
looking. Yeah. Just before COVID, and what we started seeing, I went to a few opens in Crestmead, Marsden, and they were packed. I mean, and it wasn't just like 20 groups; it was 40 groups or something. And you just thought, well, there's something's going on a little bit here. But we ended up buying in Moreton Bay. We did use a buyer's agent at that particular time, just because I was very time poor,
Mhm.
and really just to kind of help propel the strategy. And I just kind of gave the numbers and where we wanted to buy.
Mhm.
Um, and so we bought up in a suburb called Griffin, and that
Good
was
suburb.
600. Yeah,
Good suburb.
630. So a bit of a newer house, which is a bit different to what we've been buying before.
Mm.
Um, Decent rental yield, sort of good depreciation on that property. But yeah, and that was renting for about 550 or something back then.
Yeah.
So not amazing, but pretty good. So we got that one done. Then we bought a duplex in somewhere called Goodna, which was bought
Oh,
for
yes.
630, renting at 620, 630 a week then.
Hmm.
That's now worth 1 million and renting for about 950 a week
Wow.
now. So
That's gone up
that's
so much,
incredible.
eh?
Well, it's just incredible. Like duplexes, like across the board here, have just gone crazy.
Okay.
And because it's on like 1,000 square meters as well, it was a really good one.
Good. Excellent.
So we did really well there. And so yeah, we did these in a quick short period of time, and then that particular time, what we did notice that I mean the Brisbane market. Well, I suppose this was 2020 to coming towards 2021, but it was growing. It grew significantly, as you'd know.
Mm.
Like Logan just exploded, and
Correct.
Moreton Bay, and so we thought, do we just keep going in Brisbane, or do we kind of look to spread the risk? At that time, what was it? We had like I think it was 6 properties in Brisbane. So
Mhm. Mhm.
um,
Fantastic.
we looked at the data and talking to a few people that we know, we decided to go over to Perth in 2021. And I didn't know any much about Perth. My wife did uni there, but we decided to go over there, and we bought in a suburb called Naranda, which is quite close. It's in like Morley, it's quite close to the CBD, about
Up close
10
Morley.
k's.
Yeah.
Yeah, so they're putting a train line in there,
Mm.
and that was a 4 bed, 2 bath on 800 square meters, I think it is.
How much did you get it
Just
for?
630,000 that one, and that was renting for about 550 a week back then. So that was we thought we could adopt the cash flow, but we thought that was a good enough deal from a capital growth point of view to
Mm.
yeah to keep. And I mean that one's now worth 950, and it's renting for 800 a week. So
Excellent.
yeah,
Wow.
so
No brainer.
so that's been a good one. And so we got that one, and then we moved on and we bought another one up in a suburb called Quinns Rock,
Rock. Yeah.
which is about 30 k's north of Perth, and
Okay.
we got that one for 587. That was renting at that time for 520 a week. but now that's it's probably worth about the mid 800s, I'd say, and it rents for so 740, I think it is, a week.
And are
So
all these just bread and butter properties? So, you've essentially go, no, I'm not trying different strategies anymore. You try subdivision, you've tried the renovate
yeah,
equity release type of strategy. Obviously, a lot of them you have to evolve, you have to adapt as time changes. But now you kind of just go, I'm just going to buying bread and butter properties and I'm going to hold them for long term. That's the overall strategy that you've kind of
yeah.
switched in terms of your latest acquisition
that
journey.
that 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 was really going back to the Jan Summers kind of like buying under the median price.
Yes.
One thing we wanted to stick to was 4 bed, 2 bath.
Oh, yeah.
And it maybe if there's a bit of value add potential, but really just sticking to 4 bed, 2 bath, high owner occupied sort of areas. And really trying to stick with those for the next two purchases. And I mean, Queen's Rock did. I mean, it was one of those things you kind of like you half regret now when you look back on it, but it did have a swimming pool, and there has been some maintenance items on that property. But it's obviously there's a lot of appeal to owner occupiers like buying that property. I think it's got a hot tub, so I wanted to we wanted to
Okay.
live there for a bit. So yeah, and it's I mean it's a good beach there, and so we're off at the races really in Perth, and then we got another one not too long after in Rockingham. So that
Yep.
was more of an investor area,
Okay. Yeah.
and, and we picked that up for 475 or something like that, and that was renting at that time for 520 a week. That's now worth about 750, renting at 650 a week, I think it is.
Well, it would be a
So
cash flow play then, basically, isn't it? So
that was the cash flow to balance out,
it's a
yeah, the
cash
more
flow more
negative
than
style
just
ones.
cash flow.
Yeah,
Yeah. Very
yeah.
good. Okay.
And yeah, and we it was there was there was a lot of tide talk. That was when the it was on fire on Property Chat. Everyone talking about Waikiki and Rockingham
Mm-hmm.
and all these areas, and Perth really came out that slumber. It was quiet from 2009 to 2020 to 21, and then it was just even the sentiment at the time. Are you crazy buying in Perth? Like everyone wanted to buy in Brisbane, and you're like, and I think as an investor, you need to be as soon as you hear that sort of stuff, you think, well, I'm onto something here. And
Exactly right.
and
You
so
get you get the best return on investment when you're the early adopters, essentially. And that's what you did, right? Essentially, you went into Perth. Like, I don't think many people were looking at Perth around 2021 at all. Like, people were looking
not
at
many.
Queensland, Logan. That's when Logan really started taking off. I don't think anyone was looking around Perth. So well done in terms of picking those areas, that's for sure. Mm.
Yeah, no. I think it's one of the things with property. We're talking about Jan Summers, and there's so much information out there now, and there's
Yes.
there's the rise of the data-driven analysis and the data-driven buyers agents, etc. But I think they overcomplicate a very simple sort of thing, and it goes back to Jan Summers' kind of ethos, buying major cities, around the median with okay sort of cash flow, and just buy when you can. And I think it doesn't need to be as complicated as it's made out. And
Yeah.
I don't know if you remember, and this is maybe going off topic, but 2010 API and all the magazines,
Oh,
and
yes.
everyone was looking at these regional areas. There was Musselbrook in the Hunter Valley, there was Port Hedland and Moranbah and Gladstone. I remember like Your Money, Your Call, like someone just talking about Gladstone all the time,
Mm.
and it just never really computed with me. Like, why would you do that? Like going back to the investment banking, you had the junk bonds with Michael Milken, and the junk bonds have the high yield for a certain reason. So there's got to be something to it. And but the API, I mean, they were championing these guys like they're winning investors of the year and all this stuff, and I just didn't subscribe to that. I think there's a bit of that going on now, and I think people just just don't learn from history sometimes, and I might be totally wrong, but it does feel a little bit of like that. And I think just coming back and just applying those principles, looking at the capital cities and where each one is at the property clock, and then even if you're early to the party, it's better to be early than late. So,
Yeah.
and that's kind of what's stood us in good stead. And
Yeah.
that's why with the Perth kind of like idea there.
Well done. So three properties in Perth, and that was around 2021 to 2022-ish, I say, or
Yeah, it was, and we did actually have one more in
okay.
Perth, and it was it was in a suburb called Dudley Park, which is south of
Right. Yeah.
Mandurah, and so we picked that up for 410, and that was renting for about 510, and that's now worth I think 600 650, renting for I think it's 620 now. So
Mm.
that
Decent.
was the last purchase in Perth. Mm.
Wow. That's
And that
amazing.
was
That's amazing, I have to
two and a
say.
half years ago, I think. Yeah, something like that.
Didn't
Yeah,
feel that long. Didn't feel that long, I gotta say.
yeah.
But yeah, Perth's done.
Doesn't.
Perth's done an amazing things. But you
Yeah,
certainly had
yeah,
a really good run or succession of properties around. I think that's when around the time when you decided to go, I'm just going to buy bread and butter properties, and this is what I'm going to stick to, essentially, right?
yeah, yeah. Exactly. Yeah, just I mean, obviously it helped because the interest rates were where they were at that particular time, and at that time, the actual one sort of purchasing was done, the property did have quite positive cash flow. I think we're quite like close to like 70, 80 grand a year. And then sort of with the rate rises, then that turned negative.
Yes.
But but really kind of like targeting those yields like close to 5%, like rule of thumb,
Yeah.
maybe a little bit under 4.5 to 5%, be at a decent price, maybe some value add down the track if you needed it. But we're really not thinking anything other than that, just getting because it's really, as you would know, being a successful investor too, like it's really getting the portfolio value up and letting compound interest do its thing. And
Yeah.
that was the whole idea then, which is get the NAV or net asset value, or probably gross asset value, I should say, as high as possible, and then let time do its thing.
That's right. And that's the simplest way in terms of building wealth, essentially, which I think is also mentioned in Jane Summers' book, essentially, right? Like
Mm.
you just buy good fundamental properties, you hold them for long term, and
Yeah,
it's going to come basically. The ability is to be able to hold on to the portfolio. That's what's most challenging because, like you said, we've gone through an interest rate of about 2% up to about 6% now in today's world, right? It's very different.
yeah,
And you have different cash flow challenges and you have different type of issues as you hold on to these properties. I'm sure there will be, with your portfolio, you probably get calls from property managers every now and then to say, hey Steve, so hot water system's gone. Hey Steve, does this need maintenance, need attention here, right? That's all part and parcel of it at the end of the day.
yeah. It is, and it's one of those sort of things that comes with property investing,
Yeah.
and one of the most important things that we've kind of had that learnings from that sort of Pasco Vale South, because I don't regret it at all. Like we've learned so much through that whole thing. Is having the cash buffers in place. I think it's almost the most important thing you can do as a property investor. And
Mm.
so for the rainy day sort of like slush fund if something goes wrong, and so yeah, when those rates started going up, and like you said, we've had a fair share of maintenance items, yeah, which we've had to sort out. So having that was good, but it was a bit of a shock because you would remember, like I didn't think we were supposed to see any rate rises till 2024, but yeah, no, the RBA are a little bit maybe premature with that decision, but I think they handled it really well. But anyway,
No,
a
they,
bit,
they certainly
yeah,
done the
yeah,
job to the best of their ability. Let's put it that way. When you
yeah,
say buffer fund, I'm curious, how much do you think is sufficient in your opinion, as a buffer fund for each property?
yeah. Well, I'm quite risk averse, so I like to sort of like budget at least 15K per property. And
Okay.
so I've kind of like have that as a bit of a, but it could like there's quite a few people with a little bit less, 10K or so. So, but yeah, that's kind of what we've had. And then obviously with a lot of properties, yeah, no, so there's been quite a few funds held back, and yeah, no, it's been good having that in place.
I think that's a really good figure to stick with. But 15K is difficult to save in today's environment too. So I can imagine, most people will probably try to squeeze and try to stick around
Yeah.
with what they can.
Yeah, no, that's it's true, but I guess obviously with a couple of sales of property, but then yeah, there was obviously equity release, and one of the other things is going not I'm obviously really pumping up Jen Summers today, but it's also common sense. Just that's why a good broker, like yourself and others come in. Like if you've got the borrowing capacity, generally buy, but if you can extract the equity and you can keep it there, that's another way of just having that slush fund just available, just if you need it.
Very true. Very true. No, absolutely, mate. All right. Well, I'm cautious of the time. And look, Steve, you've given us a lot of information, a lot of wisdom as well. So thank you for sharing. But just before we wrap up today, the typical question, what would you say to the Steve that's 20 years ago if you are able to give him some advice? What would you tell him different?
well, you probably know the answer to that. So
I
I
know.
think I think it really would be just don't overcomplicate it. Just stay the course. Just buy those bread and butter properties with decent sort of cash flow, and just keep going and going and going. So I think that would be it. And I think it's really hard to do, like because I say this all the time. Property investing is really easy, but it's really hard, and really because the hard thing is just doing the same thing day in day out,
Correct.
and sticking the course, and not getting distracted by maybe looking at value investing in stock, or trend trading in stock, or now it's Bitcoin or wherever it might be.
Yeah.
But just keeping the same sort of flow. So I think that would be the advice. Just don't listen, tune the noise out. Just do what you think's right. You kind of know more than people who kind of equate it to sort of like, let's just say you play golf. You're a 12 handicap in golf, and then you wouldn't get lessons from a 28 handicapper. And I
Mm.
think that's kind of what was happening. Like I was just listening to people who'd never invested in property before, and then so you just got to drown that noise out. Don't listen to people, family, friends. They're all kind of well-meaning, but just tune it out and just just stick to the goal, and that's definitely what I would say.
Keep it simple is the way I look at it,
Keep it
basically,
simple,
right? Keep it
stupid.
simple, especially in the world that we live in. There's so much noises, right? About how to make quick money, how to and like how to be rich, how to get rich fast. That's one of the things that everyone wants to get in, but unfortunately, we know the reality today is. It's property is really a get rich slow scheme. You need time and you need cycles and you need patience and you need a lot of discipline, as you said. So just stick with it.
Yeah, a lot of discipline, and it is hard, but there is a lot of, as I was saying earlier in the pod, there's so much information out there,
Yeah.
and there's so like get rich quick, and it might be like going back to the mining analogy. It might be, oh, we found this amazing regional town, and the data's like amazing, like you kind of like the high owner occupiers, like no stock on market, and you can make and lots of people are going in there, and I probably shouldn't say this, but because it might be offensive, but I do tell clients that it does feel a little bit like what happens in Wolf of Wall Street with Jordan Belfort,
Yeah.
where you've got like Stratton Oakmont, and they're kind of like, yeah, they're buying the IPO, the initial public offering,
Yeah.
and the sales guys are going out there and fluffing it up, and so where is this growth coming from in these sort of places? Is it just kind of like big activity from buyers agents or investor-led sort of investors who are kind of maybe bidding against each other, and then what happens when the music stops? So
Mm.
so so and then you just see something like an advert just come up, and someone's made a 100,000 or something like that. And but like you say, like it's get rich slow, and that was always going back to kind of what I was taught. And I'd much be happier going into a quiet market knowing the growth's going to come,
Yes.
and just thinking 10, 20 years down the line, and that's kind of reserved as well.
Yeah. Yeah. No. No, thanks, Steve. Appreciate your wisdom today and appreciate your time for sharing all your stories. We'll love to get you back on again, that's for sure. We'll talk a bit about I guess, the areas that you're looking at and the areas in which you believe there's prospects for growth, which I know you're currently looking for your clients. So, I reckon we'll bring you back on shortly and to discuss a bit more on that then.
That'd be awesome. No, thanks ever so much for having me, David. It's been a blast. Enjoyed every minute of it.
Thanks, mate. We'll catch you around.
Okay, thanks. Cheers.
See ya.